Hey, so today we're going to dive into a really powerful strategy that honestly most everyday investors just don't pay enough attention to. It's called sector rotation. It's all about understanding the market's natural rhythm, and once you get it, it can completely change the way you look at your portfolio. Let's jump right in.
So let's just start with this number, because it is absolutely wild. 23,000%. Okay, so what is that? Well, that's the theoretical return you could have gotten between 1990 and 2020 if you had perfectly rotated into the best performing sector of the market each and every quarter. Now, just to put that into perspective, the S&P 500, it returned about 1,800% in that same period. Look, nobody has a perfect crystal ball, but that huge gap, it just shows you the incredible potential that's hiding in plain sight within the market.
And this isn't just some old historical data. I mean, look at what happened just recently, in 2022. Tech stocks, which had been the darlings of the market for years, got hammered, falling a crazy 28%. But at the same exact time, the energy sector was on an absolute tear, soaring 59%. If you were just holding on to a static portfolio, you either felt a lot of pain or you missed out on a massive gain. This is that market rhythm in action right here.
And that really gets to the heart of the problem. You know, a lot of us, we treat the stock market like it's just one big thing, a single entity where everything goes up or down together. But that's just not how it works. In reality, it's a bunch of different industries all kind of dancing to their own beat. And thinking of it as this one giant monolith, well, it's a huge mistake that ignores these predictable shifts happening right under the surface.
So what's the answer? Well, it's a strategy called sector rotation. Now, let's be clear, this is not about some frantic, high-stress day trading or trying to time the market perfectly. It's actually based on a really simple idea. Different parts of the economy do well at different times, and we can strategically and calmly position our investments to ride those natural waves.
Okay, so to really get this, you got to understand that the market basically has two different faces. On one side, you have your cyclical sectors. Think technology, or companies selling cars and fancy vacations. Stuff we want to buy when times are good. They thrive when the economy is booming. And on the other side, you've got your defensive sectors. This is stuff like healthcare, or the company that provides your electricity. Things we need no matter what the economy is doing. They tend to be the steady players when things get a little shaky.
You know, a great way to think about all of this is with a simple metaphor. The economy moves in predictable seasons, just like the weather. You've got your spring, summer, fall, and winter. Some sectors are built for sunny, booming growth, while others are designed to weather a storm. The real key is just knowing which season we're in, and maybe getting a sense of the forecast for what's coming next. And here they are, those 4 economic seasons. So coming out of a recession, you have what's called early recovery. This is where financials and real estate often take the lead, as people start borrowing and building again. Then, that flows into the mid-cycle expansion, the good times, where technology and industrials really hit their stride. As things start to peak in the late cycle, you'll often see energy and basic materials do really well. And then finally, when a recession hits, investors run for cover in those defensive sectors like healthcare and utilities. It's a pretty logical flow when you think about it. All right, so that's the million-dollar question, isn't it? It's one thing to know that these seasons exist, but how in the world do you get the weather forecast? How can you spot the signs that the economic winds are about to change?
Well, this is where it gets really cool. Investors use what are called leading economic indicators. Think of it like a dashboard for the economy. For example, the yield curve has an amazing track record. When it inverts, which just means short-term bonds are paying more than long-term ones, it's this classic alarm bell for the economy. Then you have things like the ISM index, which is basically a monthly health checkup on businesses, and the leading economic index, or LEI, that bundles 10 key data points together, specifically to find these big turning points.
Now, I know what you might be thinking. Looking at yields curves and economic indexes sounds super intimidating, right? But here's the real key. You do not need to be an economist to use these ideas. You really don't. All you need is a simple, practical playbook for putting this knowledge to work.
And a really popular playbook for this is called the core satellite approach. The idea is brilliant in its simplicity. You keep the big chunk of your portfolio, let's say 70%, in broad, stable, low-cost index funds. That's your core. Then you use that smaller piece, the other 30%, your satellite, to make these tactical shifts between different sectors based on what economic season you think we're in. It's a really balanced way to try and boost your returns without betting the whole farm.
So, how do you actually do this? Well, the easiest way for most of us is with sector-specific ETFs. That stands for exchange-traded funds. These are awesome. They trade just like a single stock, but inside they hold a whole basket of companies from one specific sector.
So as you can see here, with a single click, you can invest in the entire tech sector or the financial sector or energy. They're a super efficient, low-cost way to put this whole strategy into motion.
So let's just hammer this point home one more time because it's really important. Sector rotation is not a get-rich-quick scheme. It is not about trying to perfectly time the market. It's a disciplined strategy. It's about systematically managing your risk and capturing opportunities by simply aligning your portfolio with the big fundamental shifts happening in the economy.
Which really leaves us with one final thought. The internal gears of the market are always turning. Leadership is always shifting from one group of companies to another. So the real question you have to ask yourself is this. In a market that is fundamentally designed for rotation, is your portfolio built to just stand still?